So now we're going to take time for a quick question and answer session based on the questions that you, the subscribers, submitted ahead of the taping of this broadcast. I believe, Carolyn, don't you have our first question for today?
I do. So, Fred, you brought up a great point that stocks like new economy stocks like Illumina are great bargains right now. But what if investors have just been caught off guard with this whole decline and don't have money to invest in new ideas, and they're wondering, actually, should they have gotten out, and how long is it going to take for their portfolios to get back to where they were just a month ago?
Over the past century, every panic that we've had that's anything comparable to this has generated substantial, strong returns in the period following that. Those that were out of the market have been left behind, but those that were in, stayed in, rode it out, have achieved major results. You can see that in the table that we're showing on the screen.
Carolyn, do you mind breaking down what we're seeing on the screen here?
I have customers saying, well, didn't you know, I had a feeling that the market was going to go down and we should have sold out, because now we can just go in and we'd have so much more money. But that assumes that you're not going to be influenced by what we call confirmation bias. So once you're out of the market and you were so smart to get out, what the research that you automatically tend to gravitate to is research that suggests that the market's going to go down more and more and more. And what this chart shows is that actually, even it starts from 1929 to 1932, even with an 86% decline during that time period, over the following 5 years, your average return was almost 36% per year. And from 1937 to 42, your return after a 60% decline was 20% per year. More recently, that most people recognize from the 08-09, when the markets were down 56%, over the next 5 years, your portfolio would have grown 25%. And I think most investors would be more than happy with a 25% rate of return. But Fred, we're talking about returns for the S&P 500. I know in trends you've talked about your Par 5 portfolio, where you're actually investing in companies where the analysts are saying, holy cow, this company's not going to grow by 15%. Their earnings are going to be growing by 20 or 25%. And so you're actually seeking companies that are exceeding analyst expectations. And your analysis has shown through the AAII that these portfolios have grown far in excess of the S&P 500. As a matter of fact, your Par 5 portfolio, according to the AAII, has grown 24% a year since 1998.
Yeah, in spite of the decline that's associated with the dot-com crash and the decline that was associated with the financial crisis in 2008, the portfolio has grown at an average annual rate of 21% of over 21% per year since 1998.
And just to be clear, that's in far excess of the S&P 500.
That's right.
I want to add to it, Fred, is that when people are talking about the earnings of the market, they're talking about S&P 500 earnings. Many of the new economy stocks, their earnings are not even affected by this whole quarantine coronavirus crisis, because they're digital firms, or they have subscription revenue, and they're still growing while people are held up at home. And so their earnings are so totally different from S&P 500 earnings.
Exactly. Just because they're not, in other words, they're not dealing with matter, they're dealing with bits and bytes. So therefore, they are driven by things that aren't disrupted by this kind of a panic when you have a pandemic or any other kind of a natural crisis.
And yet, if I'm not mistaken, their stock prices have fallen just as much as the S&P 500.
Yeah, when the 2008 financial panic took place, only about 25% of equity money was in index funds and ETFs. Today, it's well over 50%. And so what happened was, as the unsophisticated investors, in particular, in those index funds were hit by the specter of this impending disaster, at least in their minds, they immediately sold off everything. And so therefore, by going to cash, they forced down the price of everything in that index, whether it was a really strong company in a new industry or it was a weak company in an old industry. And so consequently, you've now got extraordinary bargains that you haven't seen for years. And that's what we're now trying to do, is to identify specifically those companies that will be huge winners when this comes back, because they were knocked down with everything else, but because they're intrinsically much more valuable. And so this is the once-in-a-lifetime opportunity to get on board with the stocks that are going to drive the fifth techno-economic revolution.